Now we're going to move on to the two most important investment vehicles that we're going to need to learn about, especially in the early stages of our life when we're saving for our future, like retirement or purchasing a house. So the first one is going to be a TFSA, or a tax-free savings account. Now, this is a Canadian investment that provides tax savings for residents of Canada who are the age of majority. You're also able to invest in mutual funds, GICs, and saving deposits depending on what level of risk you want to. Must be 19 plus in BC. Now, you're able to contribute up to the maximum eligible contribution limit. Now, in the past few years, this has been $6,000, so this means you cannot put more than $6,000 a year in this account. And there are no taxes paid on the interest earned in your investments. Now, let's say you put $1,000 in 1 year, that turns to $1,100. That's a 10% increase. That's really good. The stock market on average returns only around 8%. So a 10% would be a really good investment. Let's say you did that. If you did that, in any other way, you'd be paying taxes on that. But since you did this in a TFSA, you pay absolutely zero tax on it. So all that money you keep is for yourself. Same thing goes in TFSA. As we said here, we can do mutual funds, GICs, or saving deposits, but we can also do self-investing. So you can actually buy individual stocks with this. So let's say you bought Tesla stock with your TFSA. It went up 30%. That 30% was $500. So you made $500 in TFSA just through buying a stock and let it sit for a couple months. When you went to sell it and actually made that money, how much taxes would you pay on that? Absolutely zero. With TFSA, that's why it's such a strong tool, because no matter what you do in it, you'll pay zero in taxes. So why do I need a TFSA? It's free to open and your money earned is 100% yours because you pay zero taxes. Moving on to the other account we have a registered retirement savings plan, or an RRSP. So it's a personal saving plan registered with the Canadian federal government that allows you to save for the future on a tax-sheltered basis. Contribution limits are tax deductible. We'll go over that in a little bit. Has purposes beyond retirement, such as home buyers plan and lifelong learning, and withholding tax deducted at the end of withdrawal. So that means instead of paying taxes now, you can pay taxes later. We'll go over that in the next slide. So how to reduce your tax with RRSP. Deduct your RRSP contributions to decrease your taxable income. So as we just said, the contribution limit for RRSP is 18% of your annual income. Let's say you make $50,000 a year. You're able to invest 18% of that into your RRSP. Now, let's say you invest $5,000 to your RRSP. So that will reduce your annual income. So from $50,000, you subtract the $5,000 that you invested. So your new annual income is $45,000. So it's pretty simple. Income before RRSP contributions subtracted by your contribution to your RRSP, and that's your new annual income. Now, keep in mind that there are annual maximums for how much you can put in your RRSP. As I just said, it's 18%. And I'll cut to me using the link to explain more about saving with your taxes. So this is the link I have in the slide. We'll quickly go over some examples to show you the actual tax savings you can have with an RRSP. So with the example I put in the slides, or I was talking about, we talked about $50,000 and contributing $5,000 to calculate. So as you can see here, simply by just investing $5,000 in my TFSA, I was able to save $1,216 if I live in British Columbia, and then it shows it for all the provinces and territories. So you can see here, Saskatchewan, 1,451, Ontario, 1,289, and so on. So what we should kind of just analyze and really view here is what the RRSP did. So as we can see, our taxable income was $50,000 and our contribution was $5,000. So as I said in the slides, what we do is what the RRSP does is it lowers your taxable income. So what we do to quickly figure out what the new taxable income would be is we go taxable income subtracted by your RRSP contribution. So we have $50,000 subtracted by $5,000. Now our new answer would be $45,000. That's our new taxable income.